You check your portfolio hoping it's finally starting to pay you. But instead, you see tiny dividends, slow growth, and no real progress. Every time the market drops, it feels like you're back at zero again. You want your money to start paying you. Most people chasing daily income are doing one thing wrong. They're trying to withdraw money from a portfolio that isn't big enough yet. And that's exactly why they stay stuck. They jump into high-yield ETFs, see a few payments, then everything stalls. No growth, no real progress. So let's fix that properly. $100 per day sounds simple, but let's translate it into real numbers. $100 per day equals $3,000 per month, $36,000 per year. Now here's the truth. Most YouTube strategies avoid. At 4% yield, you need approximately $900,000. At 6% yield, you need approximately $600,000. At 10% yield, you need approximately $360,000. You don't struggle with income because dividends don't work. You struggle because the portfolio isn't big enough yet. So the game changes completely. This is not an income problem. Why most people fail? They do three things wrong. They chase yield too early, they ignore growth, they reset every time the market drops. Behavior destroys results more than strategy. You don't need a better ETF. You need a structure that grows fast enough, pays later, keeps you consistent. There are two completely different paths to $100 per day. Path 1. Fast income. High-yield ETFs, 10 to 15%. REITs, covered call funds. Looks attractive because income starts early, feels like progress. But here's the problem. Growth slows down, income gets unstable, inflation eats your future. High yields come with risk and dependency on market conditions. This path gives cash flow, not wealth. Path 2. Build first, then get paid. This is how serious investors do it. Step 1. Build capital aggressively. Step 2. Stabilize the portfolio. Step 3. Extract income safely. Why? The first $100,000 is the hardest. After that, growth accelerates fast. Once you cross that threshold, compounding starts working for you. Gains become visible. Momentum builds. That's when income becomes easy. But today, everything is different. AI is reshaping industries. Interest rates are higher. Volatility is normal. Cycles are faster. So what's actually working right now? A layered ETF system. Layer 1, the core, foundation. This is your base. S&P 500 ETF like VOO, total market ETF like VTI 40%. What it does, tracks the entire economy, automatically replaces weak companies, captures long-term growth. This is where your $0 to $100,000 to $300,000 happens. Why this works right now? AI is still early, not late. Big tech is dominating capital flows. Index funds automatically adapt. You're positioning yourself inside the strongest system in the world. This is how you get from $0 to $100,000, $100,000 to $300,000. And remember, most of your first $100,000 is built by your own contributions, not returns. So consistency here matters more than returns. No guessing. Just owning the system. Layer 2, the growth engine. This is where your money multiplies. This is critical today. NASDAQ 100, QQQ, Tech ETFs, VGT 30%. Because the biggest capital flows today are in AI, semiconductors, cloud, automation. These companies don't pay big dividends. They reinvest and grow fast. This is how you compress time. Without this layer, you need decades more, or way more money. Layer 3, the stability plus early income. This is where most people get emotional. They want income now, but if you add too much too early, you slow growth. Dividend ETF SCHD style, 20%. What it does, adds steady income, reduces volatility, keeps you invested. This layer gives you small income now, bigger income later. And most importantly, it stabilizes your behavior. This matters more than people think. Because the biggest risk is not the market, it's quitting. Layer 4, the income boosters. Now we use what people actually want. Covered call ETFs like JEPI or JEPQ type, 10 to 20%. These are powerful because monthly income, higher yield, smoother cash flow. They generate income from dividends, option premiums. These come last, not first. Otherwise, you kill your growth early. This is where everything connects. 40% core, market ETFs, 30% growth, tech NASDAQ, 20% dividend quality, 10% income boosters. The weekly income structure. Now we build the salary effect. Because psychologically, this is huge. Instead of quarterly payments, random deposits, we create weekly income rhythm. Here's how. Combine payout schedules, monthly ETFs, JEPI, JEPQ, quarterly ETFs, VOO, SCHD, different ex-dividend dates. Now money hits your account every week. You can structure payouts so income arrives weekly, creating consistency and reducing stress. This keeps you motivated, consistent, invested. And that's what builds wealth. The real numbers, no illusions. Let's map this clearly. Scenario A, early stage, $50,000 to $100,000. Income, $100 to $400 per month. The focus, growth. Forget $100 per day here. You're building. Scenario B, mid-stage, $200,000 to $400,000. Income, $800 to $2,000 per month. Now it feels real. This is where most people think they've made it, but don't slow down. Scenario C, target zone, $400,000 to $700,000. Now we structure for $3,000 per month, approximately $100 per day. Portfolio mix shifts, reduce growth slightly, increase income layer. Now your system starts paying you consistently. Based on real capital flows today, strongest long-term drivers are AI infrastructure, semiconductor supply chains, energy transition, not hype, real demand, automation and robotics. Weak long-term areas, pure high-yield plays with no growth, unstable REIT sectors, over-leveraged dividend companies. So the strategy is clear. Growth first leads to income later, not the other way around. What you should do next? Start simple. Build your base, core plus growth. Invest consistently, weekly, monthly. Reinvest everything. Add income layer later. Only extract when capital is ready. You've got the strategy. But here's where most people mess it up. They know what to buy, but they don't know how to structure it to actually get paid. Start thinking in cash flow architecture. Because your goal is not own good ETFs. Your goal is build a machine that pays you consistently. The acceleration trick, most powerful part. If you want to reach this faster, you need more capital flowing in. This is drip strategy at scale. Reinvesting dividends creates a snowball effect that accelerates growth over time. This is where speed comes from. Every week leads to money hits your account. Feels like a paycheck, keeps you consistent. Structuring payouts weekly creates a steady rhythm and keeps you invested long term. This is not just strategy, this is behavior control. When you switch into income, the shift happens around $300,000 to $500,000 portfolio. At this point, growth is already working, compounding is visible, income becomes meaningful. Now you reduce growth slightly, increase income allocation. Example shift from 70% growth, 20% dividend, 10% income to 40% core, 20% growth, 20% dividend, 20% income. Now your portfolio starts paying you seriously. How you actually reach $100 per day faster? Here's the truth most people avoid. It's not about returns. It's about input speed. 3 levers that matter. 1. Weekly investing, non-negotiable, not monthly. Weekly equals faster compounding cycles. 2. Income growth, outside investing. Your portfolio doesn't grow fast enough alone. You need higher income, more capital flowing in. Remember, early stages are driven mostly by your own contributions, not returns. 3. Reinvest everything. No withdrawals early. Every dollar goes back in. This is how $100 per month becomes $1,000 per month later. Biggest mistake that destroys: switching strategies too often. People chase trends, panic sell, restart, and never reach scale. And fail because they restart constantly and never build enough capital. Consistency beats everything.